Good afternoon, everyone. My name is Jeffrey Halley. I'm a market analyst here at OANDA in Singapore, and this is the weekly commodities and precious metals video. We'll go through the various commodities and precious metal CFDs that are available on the OANDA platform, and using a combination of macro insight and charts, we'll have a look at these markets and perhaps a few factors influencing them, and perhaps gain some insight into where they could be heading next. I think the main driver, as you can see, the chart in front of you, is the US 10-year note chart here on the OANDA platform. This is what has really been driving particularly the precious metals this week. To a certain extent, the big dollar itself, which has been mainly stronger this week. And what this chart really is showing is the constant rise in interest rates. So as the chart moves down, it's quoted inversely. That means that interest rates are moving upwards, and that's surely what has been going on as the market reprices the fact that we may see a rate hike in December, which I think is almost a done deal, but also that any day now we're expecting an announcement of the new Fed chairman. That almost certainly won't be Janet Yellen now. Certainly the market's not pricing that in, and it almost certainly will be someone who is more hawkish, and that's also seen more upward pressure on rates, downward pressure on bond prices. Let's crack straight into it though, and take a look at gold. It's a rather busy looking chart. Don't be too horrified by it. I think what I'm trying to show you here is when we the key support in gold is this 1260 area, this spike down from a couple of weeks ago, and it now also coincides with this blue line, which is the 200-day moving average. This comes together at around the 1260 level. We'll come back to that one in just a moment. We have seen gold make a double top at 1291.60, which is a fairly solid resistance now, followed by this 1296, which isn't quite as valid anymore. Actually, let's just take that one off for a minute to clarify the chart and pop a new horizontal line on, which comes in at the top of the spike around 1306.5. So 1291.5, 1306.5. There would, of course, be some psychological resistance around 1300, which is about the 38.2 Fibonacci. We can see this colored chart overlaying it. We have actually attempted to break the downside a couple of times past this 50% retracement again over the course of this week. Gold's generally been under pressure fairly constantly through the week due to rising yields, and the perception that the new Fed chairman or woman will be more hawkish than the previous one. Right, sorry. There is an awful lot of gold positioning out there, though, long positioning. When I look at the Commitment to Traders report, which I do happen to have a copy of right in front of me, I can see that gold positioning itself is at 66% of its yearly average. But that still was 175,000 futures long. Now, I would think that if we got down through this 1260 region, where the 200-day and the previous low was, that may well be the pain level for some of these 177,000 odd longs to start looking at chopping back on their exposures. So I think this level here, this 1260 region, is really now a very, very big level to watch. And I think until we start seeing yields moving lower or the dollar coming back, then it's going to be hard to see gold sustaining a sort of meaningful rally. Sorry, let's just jiggle that around. Right, okay, silver. Sort of a similar story, although actually this 50% retracement, if we come over to the left-hand side of the chart where I'm circling the cursor at 16.574, the 50% held very, very well a couple of weeks ago. We can see 1, 2, 3, 4, and I'll call this a 5 because it broke, spiked, and then closed a long way up. It's held this very well. So this is the key level now, this 50% Fibonacci retracement level, which my chart has around 16.5377, but depending on your charts, it'll probably be around 16.54-ish. a key level to maintain its longer term uptrend, much like 1260 in gold. Also over to just above here, we can see this previous low around 16.8489, and then the 100-day moving average, which comes in at 16.88, and that seems to be holding for now all of the drops in silver, certainly over the last week or so. So I would say that this level itself is a key pivot level, and that if we do break and close below it, we will get an extension, possibly low as this key support region here at around 16.54ish. In the meantime, it does seem to be a bit boxed between the 100 and the 200-day moving averages. Overall, actually, the price action in silver has surprised me. It's certainly looking somewhat more constructive than gold's price action at the moment. If we come over to platinum, sort of bouncing along the bottom by the looks of it. Platinum, we held this support region here at the 904 region. But when we look at the subsequent rally from this very oversold level on the RSI, we did hold exactly at the 100-day moving average, and this is a key resistance level now, and it comes in around this 946 level. We have the 200-day moving average just above that, sorry, at 956, 955.75, 956. So we really would need to see platinum have a daily close above the latter, I feel, in order to start turning constructive on it again. On the downside, two key levels here we can see straight away. This 903.85, which is the sort of the early October low before the bounce, and then this 890.00 level, and that really goes back an awfully long way. It goes all the way back to the end of last year, and you can see when I blow the chart up time-wise just how important this level is. The positioning on the Commitment to Traders report shows that platinum is very light, to be honest. So there's really not a lot of clues there. It does say that the market's probably about flat to neutral on platinum at the moment. But one would think that if this bottom level went, it may bring some more shorts back to the market. And if we break through this 200-day moving average, that's probably what it'll take before people start going back into long positionings. Palladium, my favorite metal, really. I mean, it just keeps on giving, and this week was no different. Let's just squish it up time-wise here just to show you some context about where we are. As you can see, the 200-day moving average is way down at 845. The long-term support line is around the 860 mark, and this region here is really never been tested seriously for a number of months now. And the previous times it's held beautifully and bounced off this line. So this line itself, this long-term support line, is really the key level for Palladium, and it's really hard. A bit like looking at the S&P 500 chart. It's really hard to sort of start picking tops or talking about a top in Palladium until we actually see this line well and truly broken. In the near term, we've had some previous lows around this 907 area, 906.80 on my chart, and that is also the around the 100-day moving average, which is sort of the 905 region. So I think if we this is definitely the key short-term support area around this sort of 905-ish region. On the top side, we've been had a look above 1,000 a couple of times. The first time was up to 1,001.50 before we had a $100 pullback, and then last week we saw a very brief spike up to 1,009 before we saw quite an aggressive pullback all the way back down to this sort of 947 region as the dollar generally strengthened. It does sort of seem to me that the market is perhaps a bit nervous about Palladium above 1,000 just for now, and we may need to see some sustained dollar weakness to give that a bit more legs. But that said, the longer term uptrend is still well and truly intact. Let's head over to copper. Copper's been benefiting from generally a healthy world economy, good data out of China. And of course, the People's Congress has successfully passed without incident, which has given Chinese investors almost a green light to start taking positions again. The daily and futures, the Shanghai Copper Futures Exchange, futures have seen very strong buying from Chinese retail investors. This has also pushed off the offshore copper, and we've seen even LME stocks have been running down quite a bit in copper actually over the last few months as well, which sort of implies that demand has been picking up in the near term in copper. It's had a great week. We're not too far off the recent highs, which is around this 324 region. The pullbacks have been fairly shallow as well. The key level here is this 3.30 region. I'll blow this chart out in a minute. On the downside, 297 and 290 and a half before we run into the 200-day moving average. We are sort of getting a little bit overboard again on copper, so do keep an eye on the RSI down here on the bottom right-hand side where my cursor is. It may just run out of momentum if it moves too quickly and moves into overbought territory. I do tend to find RSIs work better on these sort of commodity currencies rather than say currencies. So worthwhile definitely keeping an eye on. And we can see that this resistance level in copper goes back an awfully long way. We'd have to squash the chart up, and actually to save you the problem, you actually need to put it on a weekly in order to actually see the pattern. But we can see the first part of it over the top left-hand side. This really is a massive level, and a break and a hold above here on a daily basis would imply that copper is going to be reaching for new highs. Natural gas, moving into the energies now. Prices have been pretty buoyant this week in the States, and natural gas, mainly powered by, I believe, quite hot weather in Southern California, which has pushed up air conditioning use. So power generators have had to produce more energy to run the air conditioning, but which is sort of a perverse opposite to a lot of the rest of the states, where we're starting to move into winter, which is usually a stronger period of demand for natural gas in the States. We are now actually testing, if I just blow this up a little bit more, the 200-day moving average, this blue line here, which is around 30050. But we can see actually that it's actually held this 200-day on any other previous rally. So it could be an intraday pivot. So if we were to move above it, it could signal an extension. Having said that, it does still, to me, look solidly locked in a range if you strip the noise out. We've had some very good days on it. I'm back up through the 100-day, but the key levels are still, to me, 275.40 and this sort of 310.70, 3.1100 level. We really need to see a daily close above or below those levels for me to start getting excited that natural gas is finally moving out of its range. Brent also had a fairly interesting week, although the last few days have been very much marked by sideways activity. If I look at the commitment of traders report, I can see that the overall Brent futures position is still hugely long, and we're at 97% of the highs to date, open position wise, about 500,000 contracts long on the ICE for the Brent crude, which tells to me the market is very, very long up here. And I'm just can't help but express a little bit of concern now that the market is at year high positioning of longs, and we can't seem to make any progress towards retesting this 59.10 level, which we saw in late September. This leads me to think that maybe the possibility is increasing of a meaningful correction to the downside. Key level here for those of you from a longer term basis is, well, there's two levels. The first one is this 55 region. So we have 59.10 on top, 55.10 below. And then this long-term uptrend line, this sloping green line here. Today that comes in at around the 55.25 mark. but this is definitely worth keeping an eye on. It hasn't seriously been tested since the very beginning of September, and it bounced off there beautifully. So this is a very nice line indeed. There's at least 4 points on this line. And so you definitely need to respect this line if it actually finally breaks. On the top side, maybe we're waiting for a bit of new news. We've got an OPEC meeting on November the 20th, but that's a long way away. I think given that the amount of good news that's been out there regarding the supply side now, possibly disruptions from Iraq and Iran, compliance with the OPEC deal by OPEC and non-OPEC countries, that we need to get some new impetus, some new news for traders to seize on, given that we already have extremely long positioning, so to speak, in the futures. Let's go to WTI. WTI is perhaps not looked as constructive. Great export numbers out of the States. The API crude inventories came in at a higher drawdown than expected. Having said that, we've broken out of this sort of uptrend line quite a while ago, a couple of weeks ago. This slightly shorter term one we broke out of this week, and it's been caused by this sort of sideways range trading. So oil's going up 1.5% one day, falling the other. It's actually made for quite a dull week if you strip out the intraday volatility, but it has moved it sideways out of this uptrend line, and we can see that we've made a few highs in the upper sort of towards 52.50, and we tested and failed 52.50 earlier in the month. It does appear to be much the same as Brent, in that we're going to need some sort of new data or news or situations to come into the market to give it another lift up. As far as positioning goes, the WTI crude futures contract still very long as well, 220,000 contracts, but key here, it's only at 53% of what it was max position size year to date. So the maximum position size must have been around about 440,000. We're only 50 odd percent of that at the moment. So there is actually still room in the WTI setup for new longs to sort of come into the market. But I do think that we'll have to wait for Brent to lead the way. Key levels, 50 of course, and then this 52.5 on the top side. We do have the 200-day moving average at 49.16-ish as well. If I just squish this chart up, this is the 53.5, 54.5 region that I've put this grey box in. This is the long-term resistance zone, and although Brent's broken out of its, WTI's has not, and it never seriously has looked so far that it's going to test it. So still some work to do there, I think, and again, possibility that we could have a correction before we move higher again. Let's get over to the softs. Look at sugar. I can tell you in advance the softs aren't particularly exciting this week, and this probably sums it all up. Very much sideways trading in the agriculturals this week. We are definitely in this range still, and that's mainly the two things I can pick out of it. We're still in this big range, 15 on the top side, 12.5 on the downside. And the other thing is that we're still holding underneath this 100-day moving average. What does this mean? So it's failed at this 100-day moving average for, well, the best part of a month now. Every rally's stopped here. To me, this is going to be an intraday pivot. If we actually break and hold above this 100-day moving average, we should get an extension of that price action to the top side. Are we going to go up there? Anyone's guess right now. All I can actually tell you is that the 100-day is going to be a pivot level, and B, we are still, when you strip out all the noise, in this sort of 12.5, 15 range. Soybeans, which broke out last week and got me all excited, are still broking out, which is making me still very, very happy. What's also made me happy is that we've come all the way back down, tested this blue line, the 200-day moving average, and held it. Probably a little too soon yet to get excited that this may be the base of the pullback, but certainly we have a support. What was a resistance line is now support at 973.30. The 200-day moving average is at 972.40. So beans do have a bit of a wood to chop here. For this breakout to remain valid, we do really need to hold this 200-day support line region. Otherwise, the whole move is in danger from a technical perspective of running out of steam. On the top side, clearly the top of this spike higher, which is at 10, is the key resistance in the short term, and a daily close is needed above here to reinvigorate this move higher. Again, as I said, it does actually, from a technical perspective, imply that there is going to be quite a big move. If you take the base of the triangle here, that's a very substantial move. We're talking maybe $4, $3. So technically, we should be heading up towards the $13, $14 mark. Far too early to say that yet, but certainly worth keeping your eyes on. If we go to corn now. And this is sort of where the excitement ended. I think the highlight for me this week has been soybeans. As we can see here on corn, we broke out of this downtrend way back in, that must be the beginning of September. But since then, we've been in a solidly demarked range trading zone. 347.50 is the top. I've got 329.50 as the bottom. There would be a case to be made to perhaps make it either 330 or sort of 330, 360, but I think this is a much more valid line around this 3.3. So let's call it 3.3, 3.475. We're definitely in a sideways range trading situation here, and we are going to need some new drivers in order to, I think, to break this range. So in the meantime, keep playing the range is what I would be saying on the corn. And then finally, wheat. Again, a lot of noise in wheat. It had a big spike yesterday as soybean wheat spreads were unwound by hedge funds on the CME and the ICE in the United States. That caused wheat to have a very good day indeed, spiking from 4.1 to 4.22. Probably the best day it's had for a while. But we can see here, when we sort of look at the bigger picture though, that we are still well and truly in a range trading situation. 439.4, call it 4.4 on the top side, 3.9350 on the downside. These are the levels that we need to break to say that wheat is on the move again. It will be very, very interesting if it was to be the downside, because that would, to my mind, set us up for a possible giant head and shoulders formation. And the shoulder I have here on the left, the head speaks for itself, and that could possibly be another shoulder. But too early to say that. Definitely we need to get back through this sort of 200-day moving average first, which is at 429.70, and above 4.40, which is almost where the 100-day moving average is for those of you who are bullish. In the meantime, it's steady as you go, range trading between that 393.50, 4.40. So not really a lot of action, I'm afraid, on the agriculturals this week, but that's sometimes how the market goes. I think the market is definitely in a holding pattern ahead of the ECB decision on Thursday, and of course announcements from President Trump as to who the next Federal Reserve Chairperson will be. So we should have some more clarity when we get together again next week. On that note, I wish you all a wonderful remainder of the week and profitable trading, and thank you for tuning in.